Well, as we mentioned, all three major averages ending near session lows. The Dow posting its worst decline since May, the S&P and NASDAQ since April. The indices closing out with their biggest weekly decline since early August. Our next guest says if the sell-off drags on, it could spark even bigger risks. Wealth Enhancement Group Deputy Chief Investment Officer Doug Huber. Welcome. Doug, a lot of this market run has been driven by the AI story, semiconductors, tech infrastructure, a big piece. Semis got shaken by today's headlines. How vulnerable would you say this market is, its main driver, especially in this AI trade, as this unfolds?
Yeah, absolutely. Thanks for having me. I mean, listen, it seems like a pretty bifurcated market here, right? Either AI execution lives up to its promise, and that certainly will benefit multiple sectors. But if disillusionment sets in, I think this could really drag valuations more broadly. And so there's going to be a lot of attention paid to major questions around what is the long-term ROI of these data center spending? How can they even afford it, given the numbers that are being thrown around? And if there is kind of a growth slow here, what is that growth premium? What is the multiple compression that is kind of the right reset if we do hit the skids?
Any place to hide? Metals?
I mean, that certainly seems the place that a lot of investors are looking right now. You saw it today. I mean, I think there's multiple legs to why gold is certainly been working. I think it started with more central bank buying, but it's probably part of this debasement trade where investors are disillusioned with the U.S. Treasury and the U.S. dollar. And so gold seems to be a safe haven at the moment. I also think if we expect rates to continue to decline, that opportunity cost of a no yield asset like gold certainly goes down. And so gold certainly seems to be a place. Digital gold in the form of Bitcoin sometimes is, sometimes isn't. Obviously today traded more like a risk asset, but you did see treasuries react today in a muted way, and so maybe investors still look to the intermediate and longer end of the curve to hide out. But at the moment, I think it's as we look to our clients, we really think more long term, and it's just about making sure our risks are in the spots we want them.
How's the government shutdown impacting the bond market right now? And here's why I ask that. Because on the one hand, you have the uncertainty. We're dragging into another week. You're seeing layoffs start to happen, although there's already legal challenges to some of those layoffs. On the other hand, if this is an opportunity for the OMB to go in and start cutting government spending in a bigger, more aggressive way and actually has a case to be made around that, I would think that would actually help the longer end of the curve and keep those yields under wraps, too.
Yeah, I mean, you could certainly make that argument. I think in general, right, the lost wages for furloughed or laid off workers, government contractors, et cetera, certainly means more fears around weaker consumer demand, especially in those local economies that are heavily dependent upon federal work. But I think in general, right, that fear of the fact that a lot of this cycle has really been on the back of the workhorse of the consumer. And so if we see continued weakening there, we obviously have softer labor markets. This isn't going to help that. There is that view that maybe you do want to hide out. And I think there has been some pressure on the back end, obviously, as the term premium's a little bit higher, again, to that idea that we are carrying a lot of debt. I think the natural buyers of the long end are a little concerned. But the fact of the matter is it has been the safe haven asset for a long, long time. And so I do think you're right in that we could see that maybe bring in the back end as fears kind of continue to percolate underneath.
Okay.